John Kay just gave his introduction, and he sketched a quite diverse but connected number of problems in the current way we manage our assets. Dutch pension funds, they manage a lot of those assets. How relevant would you say that his analysis is for Dutch pension funds in particular? Who would like to kick off on that topic? Theo, can you maybe say how you think that the Dutch pension funds find this problem on their way when they try to make these good long-term returns for their beneficiaries?
Yeah, of course, John made a lot of references to, first of all, misallocation of capital, which is, I think, getting worse and worse, that the SME business is not able to fund any money, and all the money goes to these more and more passive indices where lots of big firms are that don't need any capital and are actually just holding the capital and then use it for internal reallocation. And then secondly, the regulation is becoming more and more homogeneous in the banking sector. There are lots of rules and everybody's applying the same rules and the same modeling, and the whole thing becomes more and more connected. I think the financial world becomes more unstable instead of stable because of this rule-based regulations, especially in the banking sector. And that's a real concern if you have to invest your money in financial markets, and you see these financial markets becoming so connected and so... we didn't even discuss the role of debt, that lots of people are still now buying equity and stocks based on margins. Buying on margin in the United States have exploded since 2009 again. So this is a total, talking about booms and busts. We're heading for another boom. We don't know when it will collapse, but it's thanks to the central banks, it's getting an even worse misallocation of money than ever before, and that's a real concern for pension funds. And especially if they do want to invest in, let's say they say, well, let's avoid these markets where we have stock markets where all the capital is going into. But thanks to regulations and to the fact that our pension design in the Netherlands is really obsolete, and we need to get to another, but we'll get to that later. But thanks to what we have now, we have pension regulations that more or less demand what you should do under certain circumstances, and then that means that people have to de-risk or put a lot of money into passive benchmarks, and these passive benchmarks are these big companies that don't need that capital. So it's very difficult for people like Lars to invest in other benchmarks. You always have this issue of regulations, benchmarks, and everybody's thinking the same homogeneous single-dimensional way. So that's really a big concern for me in the pension industry.
Okay, Theo, thank you. I summarize you like you add a couple of problems to what John Kay has already sketched. So a lack of funding for SMEs and the danger of systemic risks building up.
It's increasing with central clearing platforms and all these other things. It's just everything is becoming more centralized and more homogeneous.
Yeah. Okay, thank you. Lars, you've got more problems to add to this. I mean, don't hold back. This is the period, the phase where we assemble those problems. We'll solve them later.
At this moment, I would try to answer this in a short manner. I think there's probably only one free lunch left, which is time. It's the horizon, investing horizon. If there is a group of investors who can play that advantage, it is pension funds. The average duration, even in the Netherlands, in the DB scheme, is 20 years of investment horizon. But even pension funds have become part of this financialization and part of the sort of, as Keynes already called it, the beauty contest trading game, which pension funds are in as well. And that I call always the yin and yang of investing is the short term versus the long term. And normally they are in balance, but they are now completely out of balance. And so it means, it is very detrimental to pension funds, their returns. But we don't know because we focus only on the relative performance games. So we don't even notice.
Okay, yeah, so you add that it's not only a problem for SMEs not finding money, for instance, and higher systemic risks, but actually the returns that we make, especially in the long run, investing the way we do it now, they might be lower than they could have been if we use this time, which could play on the side of especially pension funds with their long-term horizon. Yes. Gerben.
Yeah, first of all, many thanks, Mr. K, for your excellent presentation. It was fact-rich, so that's something new these days. So thank you for that. I think we can learn... True, it's true. We can learn a lot from that, and there were many elements in your presentation which make full sense. At the same time, I think we should carefully distinguish between primary markets and secondary markets. If you look into primary markets, I'm with you. The dependency on new IPOs, new issuers, is less there. We still see new IPOs, but I think like you rightfully said, so the internal, internal how do you call it? The capital allocation will be more important than the external sourcing. At the same time, we have valuation. And I think trust in the markets and trust in the true value of everything on the secondary markets will remain important. And hence, also regulation, I think, is important to see to it that the real value is actually there. I think one other issue which you did not mention, which I think personally is very important, that is actually the question, what do you measure? If we look into what actually are you measuring, what is the value of a company, what is the dependency of a company for entering the market, we might in Europe not be at a stage to say just leave it to the companies, leave it to less regulation, but even more regulation.
You think that regulation can help bringing to the table a lot of other information which is relevant for investors as well?
Yeah, I think in the end, the investors will have more responsibility than just return on investment. So there will be a requirement to actually make transparent what the contribution to the society is as a company. And it was also important for asset managers and owners of capital, for the actual ultimate owners, to explain to them what the impact of the investments is. Yep. And I think regulation will help actually to provide that transparency to the markets. Yeah.
So in that sense, regulation in the future can help making the market perform better. But at the same time, you're the regulator here in the panel, as John Kay, he focused that there is a lot that regulation is doing at the moment in driving these pension funds to be short-term oriented. Point that Theo Kocken made is that regulation also may increase actually systemic risk the way they do it currently. So how do you feel about those kind of views?
I think he's right. It's kind of a blunt statement from a regulator, but I think you have to separate between bad regulation and good regulation. Bad regulation is regulation of the past, to actually force asset managers to be very how do you call it, to be very liquid. And liquidity provisions at this, stage of the economy might not be the actual good regulation. So I think to have a fragmentation of investments over 4,000 companies, like the large sovereign wealth funds and large pension funds in the Netherlands have, is not necessary. I think you can have 400 or even 40 companies to invest in and still have enough risk mitigation in the selection of investments. So that can be bad regulation. I think the good regulation, and from a market regulatory perspective I can say that, is regulation that focuses more on the structure, on the culture, on behavior. And I think the lesson learned from the last financial crisis is not that the prudential regulation and the liquidity provisions, etc., where they were not adhered to, they were not complied with, but the true element was that the behavior in the financial sector was very. And I think that behavior is not yet at the stage we like to see. That kind of regulation, which I call the good regulation, is still needed. So we should not only look into the mathematics of what is the risk, etc., but we should also dig into what is the underlying behavior or let's say the build-up of risk. And hence we need a lot of reporting, hence we need a lot of regulation to actually know what we need to see. Because if something goes wrong in the financial industry, it's not only the individual company that's looked at, but also the regulator. You should have seen it. Where were you? Hence we need the reports, we need the requirements to comply with, etc.
Mr. K, you say, well, the solution is not in regulation. We should be getting into a new culture in the financial sector. Like in your book, Other People's Money, they should be aware of that it's not their own money and that there's this fiduciary duty. But what works against it, so what does not help having the financial sector perform the way it should, is that there's a lot of incentives in the investment chain which are not aligned to the interest of the actual saver or asset owner, so to say. If I look at the panel, is there anyone who wants to explain a little bit about how this might be relevant for the Dutch pension funds as well? How is it organized, and where could this shortism, so to say, creep into investment decisions being made?
Yeah, I think within the asset management industry, where they serve the pension industry, that there is such a focus on benchmarks, and that's something that has also been part of the whole education we get on benchmarks and equilibrium theories and efficient markets. And these benchmarks became everything. Everything's people have to beat the benchmark. But actually what they have to do is they have to beat the liabilities they have to pay out 30, 40, 50 years from now. And that's what, but instead it became a benchmark game, and everything's so much focused. And then regulators tell you you don't have to follow the benchmark as long as you can explain it. But the pension industry and the asset managers around it, there's so much fear in the Netherlands because they're underfunded. They have to explain a lot of things. So if they have to explain things to the central bank or to the regulators, then it's easier for them to say, well, we do this simple benchmark, passive investments, it's cheap, low cost, so we are careful about the costs. And it's all going in one direction with the right intentions, but with the wrong result, that it's becoming very fragile, very one-dimensional. And well, some people try to escape it, like these people here, and that's a challenge, I think.
Yeah. Now, maybe if I can add to that, because I like the last picture that Mr. K had here just on the slides. I mean, it has become a little bit of a gambling industry, and if you say you're dealing with other people's money, and which is exactly what a pension fund does, you have to be responsible about that. And what I think is that exactly what you said, we should stay away from only thinking about the benchmark, because that is almost like outsourcing our responsibility of what to invest in towards a benchmark. And there is no such thing as outsourcing your responsibility, because your responsibility is always your responsibility. You cannot put that in somebody else's hands. And that means for us that we really have to think about risk in a completely different way. So it's not that we are becoming more passive because we want to de-risk. No, that is taking more risk, because we're blind. Yeah. We're completely sailing blind if we do that. So what we are very convinced of is that you first need to define risk in a different way, and then you can be more responsible about the risk reward that you are there for. I mean, that is your reason to exist.
So how would you define risk in this new way? Can you give a short answer to that?
Risk for me is not meeting your reasonable, realistic investment objectives. Risk is not volatility, and above all, risk is not tracking error. And this goes to the heart of the incentive point, which is for an asset manager today, risk is basically tracking error. And I think of a couple of long-term funds I'm engaged in, and the business of saying at every reporting occasion, to asset managers, look, we are not interested in your quarterly performance data or why you under or outperformed the index, your benchmark over the last 3 months. We have only one benchmark, which is what is your absolute return in real terms over a rolling 5-year period. And if there is one thing that we could do to change at a stroke the culture of this industry, it is to say all asset holders ought to have that as their fundamental benchmark.
Is this microphone, can you hear it well in the back? Yeah? I'm the only one having a problem. Okay.
Which means, I fully agree with your point. So coming back to the benchmarks, they were invented in the early 80s to make performance transparent and measure performance. So it was a sort of it was a good idea at that time, but now the benchmark has become the goal itself instead of the mean to the goal. So, well, with the benefit of hindsight, it wasn't, but at least it started as a good idea. So indeed, efficient markets are part of the problem. So as Keynes already mentioned him earlier, one of his famous quotes, of course, is "It's better to fail conventionally than to succeed unconventionally," and that's what benchmarks and the way we measure risk and return creates, because it's very easy to stay close to the benchmark. And that's indeed one of the biggest problems. Just to give you one short anecdote. On a seminar on the Focusing Capital on the Long-Term initiative, I was on New York, and I think the 3 main players in the investment value chain we're now talking about are asset owners, asset managers, and companies. And of those 3 groups, I was across 9 people around the table, 3 out of each groups. So 3 CIOs of asset managers, 3 CIOs of pension funds, and 3 CEOs of S&P 500 companies. And the 6 CIOs, the investment guys, were chatting about, this was going on for 10 minutes, on alphas, betas, gammas, vars, tracking errors, and the whole Greek alphabet. And those 3 company CEOs were just listening, and at some point someone asked, "What the hell are you talking about?" And that's part of the problem. We have completely lost the function with the real economy. And what Professor Kay was saying is the stewardship role we need to take and focus on companies instead of securities. That's, I think, the focus on the cash flows of those companies, which means our long-term liabilities we need in the pension funds. And that's the real objective.
I tend to agree with that. So we need to focus on the companies, we need to focus on the impact on societies. And I think those benchmarks are not invented by the regulators. I think it's a kind of a marketing tool for the industry itself as well. And it can be dangerous. So I think we need to be more sober. We need to really carefully decide what are we going to value in terms of return. Is it only the financial return? Is it something else? Is it the societal impact in positive and negatives? What are the risks you are going to manage? And I think that we need to become more sober. So we need to be able to make that assessment. So we need transparency on cost. We need transparency on impact. And what we should not have, that is exactly what the benchmark is doing now. It will create more homogeneous behavior and hence also biases. And what we see now on the markets, and I'm not sure whether it's next year or in 5 years or 10 years, you see the changeover from banking finance to capital market financing. You see the search for yield. And if those of you who work for a pension fund or an asset manager, if you invested in, let's say, safe assets, meaning corporate bonds, etc., and if it's a bond with a coupon of 0.1% for the next 10 years, you know one thing, you have no return in the next 10 years on that 30% of your portfolio. How are you going to explain that to your clients? You can't unless you search for yield. And the other 70% should at least bring a return of 5 to 6%. Hence you have an overall return of 4%, which you had over the last 8 years. This is going to be extremely dangerous in terms of behavior. So I think to look into the benchmark and to compare it with the past, to compare it with your peers, will end in another financial crisis.
Okay, thank you very much. I hear a lot of agreement amongst the panel, at least on this specific point. Is there anyone in the audience who wants to defend the benchmark? Or all the hands, they go away. Okay, I'll just come to take two remarks or questions.
Yeah, thank you. My name is Rob Heerkens, and I am at the pension fund. And I have basically no problem with the benchmarks, because I'm educated in the end of the 70s, beginning of the 80s, where benchmarks were not that prominent. But the problem was here, at this kind of buildings, in academic world, that we tried to find out, or asset managers really do add some value. So we invented the monkey, which was throwing the darts, and just looking at the stock market, and we saw that the monkey was doing has the same results, or even better after cost, than the average asset manager. And I think the problem we have here is that we shouldn't talk only about redefining the benchmark, but also basically about redefining the asset management industry. What is the added value of the asset manager industry? They are not able at the moment to convince me that not investing passive will add money for the wealth management function I have. So I start with investing passive. And if there's no convincing argument to change that, why should I? Yeah.
Okay, so you're saying I'm gladly leave the benchmark and switch it for John Kay's proposal to look at the 5-year rolling average. Only I would still expect to be a passive investor, because that is probably the best way to have a high 5-year return. Yes, you want to react to it? Go ahead.
I just want to put it very simply as what I think the answer ought to have been to the question raised by the corporate executives in that forum, and what I think the answer to that question is that fund managers today are are engaged primarily in the pursuit of alpha, which approximately taken for the market as a whole is necessarily a zero-sum game. The only way in which the asset management sector as a sector can add value is by improving beta. And it's when we get that focus that we understand what asset managers ought to be able to there to do, and that's a different asset management sector in terms of skills and structure to the one to which we're accustomed.
Yeah.
Okay, go ahead. So I understand the alpha versus passive remark that Rob made, but it's more that passive has become a small group of investments, like the Googles and the other ones, that are not in need for any capital. So we have to seek the capital somewhere else. It's not that you have to beat the market or not, but you have to allocate your money somewhere where there's a normal return and not all the money flowing into a very small part of society. That's more my complaint of these passive optimal benchmarks where everybody relies on. That's.
And maybe I can just very quickly explain of how we do it, because when we started this 8 years ago, we saw that something needed to change, and that wasn't going towards alpha. It was really a different way of looking at the underlying cash flows. And I mean, you're right about the monkey example, and of course everybody had heard that before, and it is right. But if you think about it, if you truly analyze the underlying cash flows, you do that for the long term, you make models of 10 years, and you really do scenarios of all of the risks. So not, because I completely agree with Professor Kay that if you define risk by a tracking error, that is like steering a car and only looking in the back mirror, because it's all backwards looking. If you really think about what the future of a company can be like, what they need to do, what kind of capital investments they need to make in order to do that, or what kind of people they need to attract. And that includes what kind of social programs they need to have in order to make that possible. I mean, all of these more thinking about the real economy, about the real underlying cash flows, that has helped us to perform well. And that is not a coincidence. That is just really, really hard work. But it really asks for different skill sets than the asset management industry has grown into, because that wasn't asked for a long time. So you cannot really blame an asset manager that they're not capable of doing that. It wasn't asked of them. They haven't invested in those skills. It is something else.
You talked about this enforcement and focused on individuals rather than organizations. How can this be done? Because altogether you really are painting a quite dark picture. And at the same time, there's people here that can make decisions that can help prevent that. So let's try and do that. And please help the whole community here to make sure it doesn't happen.
Thank you for your question. We're all educated over the last, let's say, 7 decades, 6 decades. So we're all used to measure everything in terms of money. And I think that is going to be in a decade, 1 or 2 from now, to be a bit old-fashioned. I think people that are employed within a company do not only want to know the salary, they want to know what actually is produced in this company. What is my role? How can I myself as a man or woman where I want to grow into? So it's not only about money, it's not only about value in terms of money. So I think society will ask more. It will ask more from the pension funds, from the asset managers on the impact of their intermediary role in society. Also from us as regulators, and hence also in terms of regulation. So people, companies need to report on more than just return on investment, more than just the risk in terms of money or future less returns, but they should do far more. They should actually focus, what is the strategy, what is my role in society, which is provided to me by that many resources, and I need to report on that. And I think that is going to be the true new reality in the next years forward. At least I hope. I don't know whether that's going to be the case, but I hope that's going to be the case. And regulation is necessary to assist that. If you ask the question and say, Mr. K rightly said, well, it should be the industry itself that has to come forward with the right behavior, the right incentives, etc. That is a bit a utopian situation in my view. It has never worked. In the end, there are always people who got out of that clubbing circuit and said, well, if people don't know me, I can do whatever I would like with that money, with that intellectual capital and what have you. So you should have regulation, I think, to make sure that people do behave. And people are just incentivized not to behave. So regulation is still required, in my view.
We certainly need regulation, but I'm a bit surprised to find out that the regulators are proactively changing the market. Normally they are following the market. So I do think that change has to come from within the industry. And talking for the asset management industry, I think indeed we as collectively on average, we do a very poor job, as it has been mentioned, certainly after all costs. So, and I think I'm very, I think there's light at the end of the tunnel. I see a lot of initiatives. I mean, this is a full audience. I've been in lots of audiences over the last 2 years where people talk a lot about the subject, want to change, see asset owners and asset managers come up with new ideas. Well, companies like you, Ownership Capital, we do the same. So there's a lot going on. But the talking is the easy part. The walking is the difficult part, because you need to step out of the conventions, the existing conventions, and to start something different. But I think it is moving, and we need to keep the ball rolling and get it going. And it's if I see what's being published, I think that's also the good news, because we obviously are in the industry, the financial industry, with a lot of analysts. They all want to measure things. We are blue people, so what's measured gets managed, and that's why we have quarterly capitalism. But the good thing is that a lot of academics help us with papers who prove more and more also on sustainable impact. You mentioned good point on we need to make impact also transparent, that also sustainable investing, ESG investing, is delivering more value. So it's going the right way, but slowly.
Lars, I know you're involved in some initiative with pension funds as well about having different ways of measuring progress. Is that something you can say something about here?
In the Netherlands, we started at 15, 20 CIOs of pension funds and asset managers together to talk about a lot of subjects, and this was one of them. And we wrote together a paper about a year ago on this subject, on what we can improve. So 5 points. It's about aligned investment beliefs between asset owners and asset managers. It's about absolute return, risk and return goals and objectives, creating them together. It's about, indeed, an alignment of interest. So also fee models and business models of asset managers need to change, in my view. It's about full integration of ESG and engagement, as an engaged shareholder. And it's about the reporting point. So we don't need the daily NAVs in this kind of world. So less frequent and more qualitative look-through on the cash flows of companies is much more important than the daily value of the securities we now trade on.
I think the regulations are relying on something that John said very well, on things like volatility. They believe that we can measure risk by measuring volatility, which is totally nonsense. It's just the opposite way. If volatility goes down, people become overconfident and they put more overconfidence in the market, and the markets are becoming even more fragile and unstable and homogeneous. And regulations they're all using the same models around the world to apply, especially the banking models, and this leads to a more unstable world. Instead of thinking about we don't understand the world, if you think risk is uncertainty, and if you understand uncertainty, it's a fundamental thing that we know much less than we think we know, then you start to go for a totally different kind of regulations where you don't come up with these models, where you just tell people, well, what's your solution? You strive for more diversity in financial institutions, where all the banks now become the same. You don't say banks shouldn't fail. Banks should fail. You need a good resolution team in the central banks or in the regulators to solve how they, if they go bankrupt, how you divide the money. And these kind of things are much more important than making banks safer by means of all kind of models or central clearing platforms, where this is what happens in the world of regulation. Central clearing platforms are gathering more and more derivatives on one platform. If they now fail, it's not that one bank will fail, one bilateral trade agreement will fail between two counterparties, but the whole world will fail. So we are building up fragility now more than ever before in society. And that's partly because of our education role, because we learned that we can control things and we can't. And if you know you can't control things, you need totally different regulations. I agree, by the way, with the behavioral part, but that's additional to. But I think let's say the prudential regulations are just totally in the wrong direction.
Can I follow up from that and try and answer the question or begin to answer the question about good and bad regulation? I mean, post-financial crisis, we have, as has just been said, emphasized the idea that what we're trying to do is to stop banks failing. The last thing regulation should have been trying to do was stop Lehman's failing. Lehman's was a terrible business, badly managed, conducted largely for the greed of its senior employees. And I haven't heard anyone since the financial crisis, a lot of people say it's a pity Lehman's was allowed to fail, but none of them go on to say, and that's because I so miss the services that Lehman used to provide and are no longer available. What we want to do is create not a world in which Lehman won't fail. We want to create a world in which Lehman will fail, and it will not threaten to bring down the global financial system when it does. And that's where we need to be on that. Let me go more widely and say that I think an issue which we need to raise in the context of regulation, which goes back to the remarks about trust in secondary markets, is to what extent the market-based model around active trading in secondary markets is serving the purposes of capital allocation for a modern economy. The thesis behind it is that this is a particularly good way of getting out into the public domain the information which is needed to achieve effective capital allocation. And what we do is we say that everyone must be able to trade in these secondary markets on equal terms, and if people would be trading on unequal terms, they may not trade. Does that really serve the objectives which we want? A friend of mine who's chairman of a small listed company in the UK invited me recently to go and talk at his annual day for analysts. And in the course of what I said to them, I said, what are you guys here for? You know that if Richard tells you anything that isn't in the public domain, he has to, anything that is relevant to the value of these securities that is in the public domain, he has to announce it to the stock exchange immediately. And that if he doesn't do that, you are an insider and prohibited from trading on it. So why have you come across London to attend this particular event? And there was and is no answer to that question. And the people in the room kind of looked at their shoes in embarrassment and hoped that I would go on to talk about something else, as indeed, in order to save everyone further embarrassment, I did. But we're pursuing an unrealistic objective, and one which would not be desirable to achieve if we actually did achieve it. And we want to give people incentives to benefit from acquiring better information about what is really going on in companies. And that's much more effective than saying every year they must make their annual report a little bit longer to cope with a variety of new disclosures that we've just thought up that we think might be helpful, which means we have the increasingly lengthy and boilerplate-filled annual reports, which we actually do. Really useful information about a company is more limited, and it's necessarily negotiated between the major stakeholders and the company. That takes us towards better regulation, which is what we're failing to do here, is to distinguish between the kind of insider trading we want and the kind of insider trading in which a guy is sitting in the boardroom, has his phone under his desk and is tweeting news to his friends who manage hedge funds. These are the people who ought to be in jail, and they ought to be in jail as fast as possible. And what we need is regulation that is focused much more on establishing, as was mentioned earlier, personal liability for what is going on in the sector. And most of all, in my mind, we need to be rid of what I've called the shocked and appalled defense. That reference actually comes not from the financial sector, in fact, but from Rebecca Brooks, who was the editor of the News of the World at the time of the phone hacking scandal. And she issued an email to staff saying she was shocked and appalled to learn that it was alleged that phone hacking had been going on at the News of the World while she was editor of the News of the World. And it seems to me the right answer to that issue is to disallow the defense which succeeded for Ms. Brooks in court, which is that there was no evidence that specifically identified knowledge of any particular phone hacking activity that was held by Ms. Brooks, even if it was true that everyone in the newsroom or everyone in that part of the newsroom was engaged in phone hacking on an industrial scale. I can find analogies in the financial sector all too easily. Bob Diamond told a Commons committee that he was physically sick on learning that there were allegations that LIBOR fixing had been taking place in his bank while he was chief executive of it. I'm not sure what it was exactly that had made him physically sick, but that was what he said at the time. I think we need to establish culpability, and we need to do so by removing the defense of absence of specific knowledge, especially since to the extent that it's true, it is actually damaging, because we want chief executives to know what is going in their organization and not to erect firewalls which are designed to protect them from the misdemeanors which are actually going on elsewhere in the organization.
Now we're on exactly the same page here. I always refer to the fact that people who are executives tend to point at rotten apples in the organization. Well, in fact, it's a rotten culture which is established under their reign. So I'm very happy that you support insider trading regulation. So that regulation is good. We agree on that. And I think executives need to indeed, they are responsible for making their house clean. You see them, the benchmark is a very good example that they did not do that also in more recent years. You see that in audit firms, and responsible audit supervision as well, where it's not about rotten apples, individual files that go wrong. It's about a culture which has established not to have internal controls internally within an audit firm. One, Mr. Kocken referred to the central clearing as a kind of a risky element in regulation. I tend to disagree. I was there on the 16th of September 2008 when Lehman went bankrupt the day before. Over the night and the full day before, we actually tried to measure the exposure we had on Lehman. This is ABP, the largest pension fund in the Netherlands. We actually had no clue, and we had to dig through all the system and call everyone. And then in the end, I had a full package, and I myself had to fly to London because something might had to change at a late stage. I handed it in at PwC, who helped Lehman in their no surrender operation. We had no clue. We had no clue about our exposures and what it exactly was, how much it was. And that is the real added value of mandatory clearing. You know exactly, there are no real exposures over the counter. It's the clearing that's taken over the risk. And of course, risk is building up there. But if you regulate it well, and you have the capital requirements there, then you better have 2 or 3 organizations you focus on and you have under control than a multitude of individual contracts you have no clue what it's all about, my view.
Short comment by Theo Kocken.
Short comment, it's not about
Then
central clearings, of course, but what happens here is that you want to have more information, and I totally agree that there was a mess, nobody knew where the exposures were, and as a result, you demand everyone in the world to trade on one platform where the average risk reduces. But if things go wrong, you know for sure that everything will go wrong. There's not a bilateral or several people run into trouble, but then everyone went into trouble. But the comment you made was, if you have enough control, then it's fine. But we never know if we have enough control, and we never have 100% control over something. Why do we centralize something and know that at some point, maybe with less risk, but with higher impact, at some point it will go wrong? And it really scares me. It doesn't scare me. We should have made a central information gathering system and not a central clearing. And that's one step too far. It's more centralized, and it's not all now 100% connected. That's my biggest point. So I agree about the information, and that's much better now. And I agree about the average risk, but I think the real extreme risks have increased now.
What to do for Dutch pension funds? I think I can distill from the discussion so far that we here agree on the fact that we need a new way of looking at risk and return, a very fundamental, different way of assessing that. And that we need to move towards a relationship between the asset owner, manager, and the firm, where this stewardship engagement plays a much bigger role. So let's assume that those are elements of a way forward. Then if we put ourselves in the shoes of a board member of a Dutch pension fund, what would that mean that he needs to do? We already had the discussion about index investments versus a more concentrated portfolio. Is it possible to have this other look at risk and return and to have this engagement, stewardship, and at the same time have index investments?
That's the asset part of the balance sheet. But still, I have regulations, a solvency type of regulation for Dutch pension funds, that's still financial regulation. So I can have real asset allocation, but real asset allocation in a financial regulation of your balance sheets gives me some head edges.
It always works best to, and that's I think also important in this subject, is to talk about best practices. So showcase pension funds who are busy with this. And so there are one of the pension funds, I think 6-7 years ago, was the Railway Pension Fund. They decided to build a strategic equity portfolio. Don't forget about the 4,000 securities they had before, but a global portfolio of 100 companies is diversified enough, and the absolute return goal of that portfolio is liability return of our fund plus 3% the equity risk premium over time, which is sort of the long-term absolute return risk perspective. So, and they do 80% of their, as I understand, 70 to 80% today with that global strategic equity portfolio. And there's nothing wrong with that, apart from the fact that the DNB asked them a lot of questions. I think there are others which have a passive portfolio and just started pilot portfolios besides the passive portfolios, doing 5, 10 or 15% of their equity book in this direction, as we just discussed today, which is, I think, because I can understand very well that trustees don't like the Railway Pension Fund. They went from completely the opposite way, which is for a lot of trustees probably too far. So they want to just learn over time, which is a perfectly reasonable example. And I see people in the room here doing that as well. So there are different ways to roam, I would say. But I think we should talk about them, showcase them, and because then they become more conventional and more people will follow.
Yeah.
Because that's how human psychology works.
Yeah. So that you already answered, I think, if you agree, your question. It can be done even within the current regulatory room that we have. But you do need to answer a lot of questions from regulators because you're doing something differently, and it breaks with the old way of looking at.
But it is possible. I mean, also,
but it is possible.
Yeah. Also, with the Dutch central bank, you can just debate this.
Yeah.
I mean, you get probably more questions than if you follow the passive index. But
yeah,
it's possible.
Yeah.
And just a small addition, I think the good news here is that the regulators are changing. I mean, we just heard this story, but also the Dutch central bank is changing. I mean, they had their report out a few months ago where they said we need more focus on ESG. Risk models should change in order to integrate sustainability factors in there. And maybe a small comment. I think that sustainability is just as financial as anything else. Behavioral is as well, because it comes into your real assets also. So therefore, you shouldn't see it as a separate chapter. It really brings something to the risk models. So I think that's the good news. So that's not really the answer to the question there, because it is, but it's good news that something is changing. So we're getting there.
Yeah. And that's, I think, the news about what you can do within the regulations, and it's not that the central bank is not necessarily, or the regulators are not necessarily hindering what this young man was talking about. But what is the problem is our pension design that is so much focused on fixed promises, which are then converted into interest rate sensitive products, and that you have to meet with all kind of complex rules and all kind of let's say, solvency-like regulations, where what you want to do is you want to invest real money into the real economy for a very, very long period of time, and you don't want to get bothered by these, by all these financial regulations. But the funny thing is, if somebody in the Netherlands is asking for new regulations, it's the Dutch central bank. Some people complain that they make such explicit statements about what they want, where they shouldn't do that because they're only the police and not the lawmakers. And I sometimes think, well, I'm at least happy that they are making some kind of a statement, because we have to move to a more real economy-based pension system, which means that we stop with all these complex funding rules and well, that we have in the Netherlands the discount rate discussion, and even it's now on the political agenda that you wouldn't understand. We have a 50+ party, which says if we change the rules and we change the way we calculate, we can give more money to everyone. That means to the older people, and après nous le déluge, to say it in French. Well, that's and they are attracting lots of voters.
In Britain too, we have a 50+ party. It's called the Conservative Party.
So I don't want to do that. Therefore, I agree with Ben. We need to change. I think that's the answer where we agree on. We need to change the pension system and not necessarily blame the regulators that they have to follow this. As long as we have this system, they have to make sure that we don't have intergenerational unfairness. But if we change the system and make it more individual, and then we get rid of that.
So you would say that getting to a more individualistic pension system is a prerequisite to have a more long-term focus in how we invest?
Yeah, but that's the individualistic. When we get to that discussion, what I mean is that you don't put money into a system and then it becomes a very complex discount and funding ratio rule, how you divide that money, and then you get all kind of regulations around it. It should still be collectively run, but you have individual entitlements. So you know what your entitlements are. You know that if you're young, you can invest in for the long term instead of young and old people having to do the same, making the same investments, which is a big problem in the current system.
Lars,
just one comment, because I think so. This is obviously a completely different topic, and we talk already a lot about it in this country. And it makes it easier if we do it, I agree. But still, every pension fund has an equity portfolio. Every pension fund has a return portfolio right now in the current regulatory system. And you can change your own life today. It's about you making the changes, not about someone else. And that's, I think, about culture. That's your own behavior. And it's the three main parties I mentioned before are asset owners, asset managers, and corporates. Between asset owners and asset managers, it's about minimizing agency issues and create more alignment of interest. And between the asset managers and the corporates, it's about maximizing engagement through really owning companies and in being in dialogue about sustainable and financial goals of those companies. And that we can change now, whatever you have in equities today.
Yeah. Okay, thank you. I think that's a very clear recommendation to the board members of pension funds. You can change now.
I think it's very good to actively manage portfolio. Why? Because the price discovery needs to be there. And if it's all passive, it's all indexed, how is the price discovery going to work? So I'm kind of skeptic on only passive managed portfolios. So I think it needs to be a combination. And one recommendation I have for you who think that active versus passive has something to do with engagement as well. I think on passively managed portfolios, you still can have very active engagement. If you have the acting in concert with a lot of groups like Eumedion, but also internationally, and if you pull together all your belongings, which are passively managed, you still have a lot of say in what the companies you invest in collectively are doing or are not doing. So I think in the end, if you organize it well, if you have the resources, do it actively. If you don't have them or the cost of execution is too high, you can do it passively, but don't forget to engage.
My name is Martin Picard. Listening to the discussion like this, I have a very simple suggestion which might offer a partial solution for at least Dutch employees, and you might like to react to it. It's just for Dutch employees to save less for retirement. We have huge pension funds, but also huge mortgages. Since the retirement age of the state pension has been coupled to the life expectancy, younger employees face a retirement age of 72 at the very least. So it's the trust in pension funds and financial system is very low. So why save so much as we do, comparatively much more than in other European countries?
We invest in real estate, we invest in private equity, we invest in infrastructure, we even invest directly in mortgages. The problem with all this kind of category, that for mortgages we had to set up a new company because asset management industry was not, was not having the product itself. And for the other three, I go back to your nice presentation, that we also, if we invest in them, we sponsor the top 1%, probably that one out of 1,000% of people who are already very rich, and we will make them even more rich. And that has also a lot to do with the trust people can have in the pension fund industry, because they really think that we are also rich ourselves, like that. So I think that the asset management industry should really also look at how to deliver these kind of products with reasonable...
Martin Picard's comment that we should save less in the Netherlands. Well, we do save a huge amount of money. We're a Puritan kind of Calvinistic people. What I agree on is that we could make it possible in a new system to make a distinction between how much you save in your own house, literally, and paying off your mortgage, which makes a huge difference. For example, if you look at the total wealth in the world, and in many countries, a lot of money goes into your mortgage, and if you don't take that into account, and you treat everyone the same, you have to save, whether you're renting a house or you're paying down your mortgage, it makes a huge difference. So I think a more individual system, collectively run, but individually with a choice whether you are paying down your mortgage or not, could make a good distinction, because otherwise you're saving just literally, some people saving twice as much as other people, and we think we all have to save the same, but it's not the case. So and that's, you have to change the pension system for that as well.
Can I just pick up on that? Because I'd hoped to put figures on the Netherlands to match the figures for the four larger larger countries that were on that slide. The Netherlands actually looks not very different from other countries, with one big exception, which is that net housing wealth is very low relative to gross housing wealth in the Netherlands. That is, the amount of equity that people have built up in their houses in your country is much smaller than in most countries, which I guess is the product of relatively static house prices compared with other countries on the one hand, and actually larger loan-to-value mortgages on the other. But certainly that's what the numbers show. And the corollary to that is that household savings outside housing are much larger, significantly larger in the Netherlands than in the other countries we looked at. So that the aggregates are in a sense the same, but there's that significant difference in distribution.
So we have 200% GDP in our pension savings, and we have 100% of mortgages. And so in that respect, that there is a huge amount of mortgage borrowing and a huge amount of savings, and that's what Martin Picard was referring to. That
still have tax deductibility on mortgages.
We still have that, yes, yeah. and on pensions. Everything's tax deductible in the Netherlands.
To follow up on that, I think Mr. Picard will have its way in the upcoming 2 months. In many of the party programs up to the election, of course, this is an element. And if you take it collectively, I can give, on a personal note, some support. There are a lot of savings, and not everyone individually will need its full pension to provide for the cost of living at a certain age. However, if you look at it individually, there are groups of individuals who are very vulnerable, and those groups actually don't know it. Those are people who nowadays are married, but tomorrow or in years from now will be divorced, will be unemployed, will be self-employed for a certain amount of years, will have problems with their mortgage. So on an individual basis, it's not at all true that people save too much. It can be that if you do the scenario and run it over the different groups, that some of the groups save less than they actually need for the cost of living. So I think we should be cautious. We should have the debates, but you should really do the studies, what kind of groups you can afford to save less and what kind of groups can ill afford it. And you also have to do some predictions on what future elements can pop up in that bumpy ride which we call life.
Okay, thank you very much. It's time for me to wrap up. And I must say, I wrap up, I think, a very interesting session which has provided not only quite a clear picture of the problems that we have with the current way that we manage our investment savings, our pension savings, but which has also shown that change is possible, even though it will not be easy, as it touches upon such fundamental ways of thinking about risk, return, very central themes in investing, and that's not only a long way of thinking, but it's also become ingrained in a lot of regulation and the way we do business amongst each other. But at the same time, I think the very hopeful thing is that there's a lot of agreement, at least on this side, and what I also sense it from the audience, that this change needs to be made. And what maybe is even most promising is that given all those difficult circumstances, there are already pension funds who are changing track, and they can do it. And the more we'll do it, the easier it becomes for the others to move in that direction. So on that upbeat notice, I want to end. And well, thanks of course very much, John Kay, and to the whole panel. After the applause that is going to break, don't run away too quickly, because there are some drinks, so we can still discuss amongst each other. Thank you very much.